Hi everyone, today we'll be going over accounts 2021 May-June paper 2-1. This is a structured paper and the total marks for this paper is 90 and we also have a time limit of 90 minutes. And since question number 4 is of 30 marks, we will be attempting to complete this question under 30 minutes. So let's get started. We are given a manufacturing business called P Limited and we need to define the following terms. Firstly, we need to define direct costs. So these are the costs that can be directly associated to the production of goods or services. For example, it can be direct material or direct labor. So let's write the definition first. So these are the costs that can be directly associated to the production of goods or services. Nextly, we have stepped costs. So stepped costs are fixed for a certain level of output and then it increases for another certain level of output. We can define it as the costs that are fixed up to a certain level and which increases thereafter. Alright, this completes the first part. Let's move on to the second one. We need to state the formula for finding the margin of safety in units. So the formula for margin of safety is just the difference between maximum output in units and the break-even point in units. So the formula is just going to be margin of safety in units. This is going to be the maximum, or sometimes it can also be budgeted number of outputs or budgeted output in units minus the break-even point. So I'm just going to write the short form BEP in units. Alright, for the third part, we need to explain the term limiting factor when using marginal costing. So we can define any factor to be a limiting factor if it limits the activity of a business. It can also be termed as a shortage of a resource. So when there is a scarcity of a certain resource, such as raw materials or direct labor hours, then we define those factors to be limiting factors when using marginal costing. So let's explain it right here. Any factor that limits the activity of a business it can also be termed as a shortage of a resource. This completes the third part. Let's move on to the fourth one. So we're given additional information relating to the manufacturing process of P Limited. The factory has the capacity to make 40,000 units per month, and we're given the information regarding sales, direct costs, fixed cost, and the company has a target profit of 40,000 per month. So we need to calculate the number of units to be sold for the company to achieve its target profit for December 2021. In order to figure this out, firstly, we will be calculating the contribution per unit. So contribution is just the difference between the sales price and the variable cost, which will be the direct materials and the direct labor. And we are calculating it per unit. So per unit, the sales price is 48 minus the direct materials cost per unit is going to be 4.5 into 4. because we require 4.5 meter of the direct materials and each meter cost $4. So that's just going to be 4.5 into 4. Then the direct labor per unit is going to be 3 times 8.50 because each product requires 3 hours of direct labor and each hour of direct labor costs $8.5. So that's just going to be 3 into 8.5. So this gives us the contribution per unit of 4.5. Now what we know is that the profit is just going to be the difference between total contribution and the fixed costs. And the formula for total contribution is contribution per unit into the number of units minus the fixed cost. So we are already given that we require the profit of 40,000. We know the contribution per unit to be 4.5. We require to find the number of units, and we're also given the fixed cost of 112,000. This is given right here. Now we can just solve this simple equation. So this is going to be 4.5 into units equals to 40,000 plus 112,000. Now we can figure out the number of units. This will be 40,000 plus 112,000 divided by 4.5. This gives the total number of units to be 33,777.78. And since we're talking about the number of units, we require to round it off. So we can just round it off to 33,778 units. So that's the required answer. This completes the fourth part. Let's move on to the fifth one. So we now need to prepare a budgeted marginal cost statement for December 2021. So for the budgeted marginal cost statement, we first figure out the total contribution, and then we subtract the fixed cost so that we get the profit for the month in this case. So let's start from the revenue. So what we know is that we're producing 30,000 units, and each unit is sold at the sales price of 48. So this gives us the total revenue to be 1,440,000. Now we need to subtract all of the direct costs. So firstly, we have the direct material. So direct materials, we require it for 30,000 units as well. And each direct material requires 4.5 meter. And each unit requires 4.5 meter of direct materials. So we're just going to multiply with 4.5. And each meter of the direct material costs $4. So we're just going to multiply with 4 again. This gives the total direct material to be 540,000. Then another one is going to be direct labor. Again, we require the direct labor for 30,000 units. And each unit requires 3 hours. So we're going to multiply with 3, and each direct labor hour costs $8.5. So we're going to multiply with 8.5. Now this gives the total direct labor to be 765,000. Now we can just subtract all of the direct costs from the revenue in order to figure out the contribution. So the contribution is going to be 1,440,000 minus 540,000 minus 765,000. That's going to be 135,000. Now we just need to subtract the fixed costs. So fixed cost is already given to be 112,000. We're just going to subtract this amount from the total contribution so that we get the profit for the month. So this is going to be 135,000 minus 112,000, which gives us the profit to be 23,000. This completes the fifth part. Let's move on to the sixth one. So we're given additional information. The directors have been told that the demand for the product is likely to fall in future months, and they are considering two proposals. So we're given the information regarding proposal A, and we need to calculate the monthly profit to be made from proposal A. So we can just repeat the entire process that we did in the fifth part of this question. We're going to make a budgeted marginal cost, but considering all of these information now. So we will be using the sales information and the direct costs as well as other fixed costs from this table. So let's first start with the revenue. So we're given that 27,000 units per month will be sold at 57 per unit. Let's note that down. So we have 27,000 units, and each unit will be sold at the price of 57. This gives us the total revenue to be 1,539,000. Now we need to subtract the direct costs. So the first one is going to be direct material. Let's have a look at the given information first. So the same quantity of material per unit as currently used. So currently we're using 4.5 meter of direct materials per each unit, but the price per meter would increase by 7.5%. So previously we were using the price to be $4. Now we need to increase it by 7.5%. Let's calculate it. So we are considering the direct materials for 27,000 units. And we will be using the exact amount that we're currently using, which is going to be 4.5. Previously, we've been using the cost per direct material to be $4, but now we need to increase this $4 by 7.5%. So in order to do so, we can just multiply it with 1.075, right? Now this gives us the total material to be 522,450. So that's 522,450. Nextly, we will be considering direct labor. Let's have a look at the given information. The rate would increase to 9.25 per hour, and each unit would take 3.4 hours to make. So this is quite easy comparing to the direct materials, what we just did. So this is just going to be 27,000 units. Each unit requires 3.4 hours, and the rate per labor hour is 9.25. This gives the total direct labor to be 849,150. So that's 849,150. Now you can easily figure out the contribution. So this is going to be 1,539,000 minus 522,450 minus 849,150. That's going to be 167,400. Now we need to subtract the fixed costs. Let's have a look at the information first. So we're given additional fixed costs, meaning that the previous fixed cost will also be included. So let's first include that. Previously, we had the fixed cost of 112,000. Now, extra machinery costing 75,000 will be required, and machinery is depreciated at 20% per annum using the straight line method. So the additional fixed cost is going to be this depreciation on machinery. Let's include that. So the cost of the machinery is 75,000, and the depreciation rate is 20%, so we can just write it to be 0.20, but we only need to include the depreciation per month, and this will provide the depreciation per year. So in order to figure out the depreciation per month, we can just divide it with 12. So that's going to be 75,000 into 20% divided by 12, which gives us the depreciation per month to be 1,250. Let's have a look at the information again. A loan would be required to finance the full cost of the machinery, and interest rates are currently 8% per annum. So we need to calculate the interest as well. Like we did before, we only need to include the interest per month. So firstly, let's calculate the interest per year. So interest per year is going to be 75,000 and the interest rate is 8%, so we can just write it as 0.08. This gives us the total interest for the year, but we only require the interest per month, so we're going to divide by 12. This gives us the monthly interest to be 500. Now this concludes the total fixed cost. We can easily figure out the profit for the month now. So we will just be subtracting all of the fixed costs from the contribution. That's going to be 167,400 minus 112,000 minus 1,250 minus 500, which gives the profit for the month to be 53,650. This concludes the sixth part. Let's move on to the final one. We are given additional information regarding proposal B. First, let's have a look at the question. Advise the directors which proposal they should choose. Justify your choice by considering both financial and non-financial factors. In order to do so, let's first have a look at proposal B. The directors are also considering a proposal to produce a simpler version of the product with a selling price of 37 per unit. So proposal A had a selling price of 57. This proposal would require 76,000 labor hours per month. So if we're considering the current situation, we were producing 30,000 units and each unit required 3 hours of direct labor. So if you just multiply it, we get the total labor hours to be 90,000. So from 90,000, the labor hours is decreasing to 76,000 in case of proposal B. They estimate that 38,000 units per month could be sold. So if we're considering the current situation, we are selling 30,000, but if we're considering proposal A, we are only selling 27,000. So the number of units has definitely increased for proposal B, but this will produce a monthly profit of 49,500. Alright, so if we're considering the current situation, we figured out the profit for the month to be 23,000. Comparing with that profit, definitely proposal B has higher profit, but we just recently calculated the profit for proposal A, which gives 53,650, which is definitely greater than proposal B's profit. Alright, so let's first list down our points. Okay, firstly, I'll have a look towards the profit. So for the first point, profit for proposal A is greater than proposal B and the target profit. We had the target profit of 40,000 in the first scenario, right? So let's just list it. So profit for proposal A is greater than proposal B. And the target profit. So target profit we had is 40,000. So proposal A has the profit of 53,650 and proposal B has the profit of 49,500. So definitely in terms of profit, proposal A sounds a better idea than proposal B. Nextly, what we can consider is the labor rate. So labor rate, if you remember correctly, we increased it in proposal A. Previously, we were using the labor rate of 8.5 per hour, whereas for proposal A, we increased it to 9.25 per hour. So we can just write that down as well. Labor rate is increased in proposal A, but not in proposal B, since nothing was mentioned regarding any labor rate. So when the labor rate is increased, it definitely has an impact on the motivation of the workforce. So having an increased payment can definitely motivate the workforce to work harder. So that's a plus point as well. We can mention it. This increment might motivate the workforce. Again, proposal A sounds like a better option than proposal B. Nextly, what we can consider is the introduction of new machinery costing 75,000 in proposal A. So with the introduction of new machinery in proposal A, it might provide opportunity for more profit in the long run. Again, proposal A sounds like a better option than proposal B. Nextly, what we can consider is the labor hours, right? Because labor hour for proposal B has decreased drastically from 90,000 to 76,000 hours. So what impact does that have on the company? We can also list it down. So labor hour for proposal B has decreased from 90,000 hours to 76,000 hours, which may result in the business having to lay off some of its employees. Because previously we required 90,000 labor hours, right? Which might mean that we require a big amount of workforce. But if we're cutting the labor hours down to 76,000, then we might not require as much labor as we did before, which means that the company has to let go of some of its employees. And while doing so, the company will face an increment in redundancy cost. So we can include that as well. This might result in increment of redundancy cost. All right, so considering these 4 points, we can definitely make a proper decision. So we've listed the points favoring proposal A. So our decision is also going to be choosing proposal A. The directors should choose proposal A. All right, this concludes the 7th part and also this question. Also, we've finally completed this entire set. If you found this video useful, make sure you leave a like and leave a comment below. Make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.